Coming up on Market to Market. The clock is ticking on a potential government shutdown while partisan bickering rules the day. A study indicates sub-therapeutic use of antibiotics in livestock production may lead to trouble. And as one of the worst wildfire seasons continues, officials seek to calculate the risk. Those stories and market analysis with Jamey Kohake next.
This is the Friday, September 27 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Consumer confidence in the economy has been shaken over the past few months, while businesses and industry appear to be throwing off some of the weight that is slowing growth. According to the Conference Board, consumer confidence decreased last month as concerns about the short-term outlook for both jobs and earnings resurfaced. Despite the change in attitude, officials with the Commerce Department say orders for durable goods, items expected to last at least 3 years, increased 0.1% in August after plummeting more than 8% in July. When the volatile aircraft sector is removed, core durable goods, a leading indicator of future economic growth, also rose 1.5% after posting a decline. With the October 1st federal government shutdown looming, Treasury Secretary Jack Lew told Congress this week that the government's ability to borrow funds will end on October 17th. And Wall Street suffered losses 6 of the past 7 sessions in anticipation of Washington politicians remaining deadlocked well beyond midnight on September 30th. Unless a bitterly divided Congress sends a temporary spending bill to President Obama before Tuesday, the federal government will be forced to shut down. Never ones to let a good crisis go to waste, Republicans seized the predicament to further their agenda. And with the clock ticking to yet another self-imposed fiscal deadline, Tea Party Republicans practiced a little brinksmanship this week, promising to approve the spending bill, but only if the legislation also abolished funding for President Obama's signature health care overhaul.
Do you like green eggs and ham?
In a rambling floor speech that alluded to everything from the Revolutionary War to Dr. Seuss, freshman Senator Ted Cruz kept the Senate in session Tuesday night in an all-out attempt to derail President Obama's signature health care law.
Not in a box, not with a fox. Not in a house, not with a mouse. I would not eat them.
For 21 hours and 19 minutes, the Texas Republican charmed the Tea Party wing of the GOP, irritated leaders on the other side of the aisle, and complicated efforts for House Republicans seeking support for the spending measure to avert a government shutdown.
Obamacare. The only path, if we're going to oppose Obamacare, is to stand together and oppose cloture. And I would ask for my friends on the Democratic aisle to listen to the
hour of noon having arrived pursuant to the order of the Senate will be in order. The senators know better, and the Senate will be in order.
Ultimately, Cruz ran out of time, and the Senate voted unanimously to continue debate on the controversial proposal.
I expect my Senate colleagues to do everything they can to defund this law, just like the House is going to do.
While the House has already approved legislation defunding the 3-year-old health care law, Senate Democrats have more than enough votes to restore the funds, and Majority Leader Harry Reid called Cruz's turn in the spotlight a big waste of time. But Senator Charles Grassley says it's Harry Reid who is wasting time. The Iowa Republican questioned Reid's leadership and praised Cruz's quasi-filibuster.
It's really serving the main function of the United States Senate, which is to deliberate. Historically, that's what the Senate done. But under Senator Reid in the last 6 years, filing cloture to cut off debate, filling the tree so any senator who has a right to offer an amendment under the precedent of the Senate doesn't get a chance to offer amendments. We've gone from having about 500 roll calls a year 6 years ago down to about 300 and some. We are hardly meeting on any Fridays. We don't start voting on Mondays until 5:30. Reid has basically shut down the Senate so it doesn't fill its constitutional function of being a deliberative body. And when you have somebody like Cruz and, you got to applaud him for having the Senate serve the constitutional function of deliberating. And
Any differences between the Senate and House in the spending measure must be reconciled and the bill signed into law by next Tuesday to avert at least a partial government shutdown.
Midday on Friday, the Senate passed a continuing resolution to keep the federal government open through November 15th. Voting was along party lines. The measure will be sent to the House for consideration, but the question remains on whether debate will continue until the 11th hour Monday night. President Obama reiterated that the bill will not get his signature if the final measure lacks funding for the Affordable Care Act. Somewhere in the distance, behind the giant political roadblock in Washington, lays the Farm Bill. And with little or no time left before the continuing resolution expires, another extension of the 2008 Farm Law is all but certain. The languishing Farm Bill authorizes federal spending on everything from nutrition to disaster payments. But while attempts to find a compromise continue, work by other agencies goes on. With residents of the West facing the tough job of cleaning up from one of the worst forest fire seasons in history, federal officials are attempting to provide a touchstone for calculating the danger.
Federal researchers are working on a system to measure and predict the destructiveness of wildfires, similar to those already in place for hurricanes and tornadoes. The National Institute for Standards and Technology hopes the Wildland-Urban Interface Hazard Scale will tell residents the intensity of a likely wildfire burning in their neighborhood. The scale will help predict the potential destructive power of a wildfire, given the combination of fuel and location. The proposed scale of E1 to E4 creates regions based on location, anywhere from grasslands to remote mountain canyons. The scale is aimed at beefing up building codes and buffer zones in high-risk areas. Insurance companies are also paying attention to the research as payouts after western wildfires have grown exponentially. In the 1970s, wildfires destroyed about 400 homes nationwide. Since 2000, that number has topped 3,000 structures annually. In Colorado alone, wildfires accounted for more than $858 million in insurance claims in 2012 and 2013, according to the Rocky Mountain Insurance Information Association. Researchers are looking at building materials, landscaping, weather patterns, plus the behavior of wind-driven embers.
So if you understand the exposure, you can then design to that exposure.
Historically, big insurance claims involve flooding, but fires are gaining ground. The government is also remapping flood zones and trying to restore solvency to the National Flood Insurance Program. The change will likely raise rates for nearly everyone.
We paid $1,482 for our flood premium this year. The best estimate we have right now is $12,000 to $16,000.
Congress passed the Biggert Waters Act last year to mandate rates more closely match true risk.
Everyone's going to pay more for flood insurance. It's just a question of how much. And we've seen so many floods now, Colorado, last year Hurricane Sandy, before that other parts of the country, and it's obvious that the FEMA program is bankrupt.
FEMA will be paying to help thousands displaced by the latest round of flooding in Colorado. This week, Vice President Joe Biden toured a portion of the $1 billion in damage in the Centennial State. Flood damage to Colorado's oil industry has state regulators monitoring spills and damage to equipment in oil fields north of Denver. At least 37,000 gallons has spilled in a dozen incidents, according to the Colorado Oil and Gas Conservation Commission. And construction crews are trying to get emergency repairs done to flood-damaged highways and bridges, where the price tag is already close to $430 million. Crews are attempting to complete their work before the fast-approaching winter weather season hits.
The owners of a Colorado cantaloupe farm determined to be responsible for the 2011 listeria epidemic that killed 33 people were arrested late this week. The Jensen brothers were charged with introducing adulterated food into interstate commerce, a misdemeanor. According to the Centers for Disease Control, roughly 1 in 6 Americans, about 48 million people, get sick from contaminated food annually. 128,000 are hospitalized and 3,000 die from foodborne illnesses. Some diseases are more easily fought with the use of antibiotics, but you can have too much of a good thing. Overuse can lead to antibiotic-resistant bacteria. But stopping the spread of disease can be problematic anywhere, even in the feedlot. Finding ways to check the spread of infectious animal diseases has USDA working on a number of new vaccines.
In the wake of outbreaks of porcine reproductive and respiratory syndrome, or PRRS, USDA is making efforts to secure the health of the nation's swine population through the development of new vaccines.
For breeders and producers, they well know that once you have a disease, many times you have production losses. And with PRRS, we know there's $642 million production losses per year in the United States alone.
Though a majority of pork producers raise their animals in biosecure environments, USDA warns livestock operations are still susceptible, mainly due to human activity. The agency cautions diseases can enter an operation on truck tires, on shoes, or in shipments of new stock from grow-out facilities. The problem has Agriculture Department scientists working to prevent the spread of deadly bacteria.
To be able to design more effective vaccines, to be able to know what their immune response is, and to ask whether genetically some of them may be better responders to vaccines. We call them vaccine-ready pigs.
These efforts come on the heels of a recently released report from the Centers for Disease Control and Prevention. Antibiotic resistance threats in the United States 2013 warns of a festering pandemic of superbugs able to thwart current medicines. CDC officials claim the overuse of common drugs has encouraged several bacterium to develop immunities. The report declares antibiotics should be used in food-producing animals only under veterinary oversight and only to manage and treat infectious diseases, not to promote growth.
Antibiotic resistance is one of the most serious health threats we face today. We risk entering a post-antibiotic era where even simple infections can be deadly.
For the past decade, sub-therapeutic antibiotic use has skyrocketed as a method of promoting rapid weight gain in meat production. Over 70% of all antibiotic drugs sold in America go into animal production, particularly chicken and hogs. But drug-resistant bacteria are already present in the nation's meat supply. Officials with the Atlanta-based Health and Safety Agency warned these resistant bacteria can be passed on to the consumer when meats are undercooked or handled improperly. CDC scientists estimate a $20 billion annual bump in healthcare costs and another $35 billion in lost productivity will occur each year should the issue go unchecked. Currently, there are few federal rules governing the sub-therapeutic use of antibiotics. This means compliance to current industry guidelines is voluntary. The Food and Drug Administration echoes the CDC's warnings of the speed with which pathogens can evolve under such conditions. FDA guidelines promote judicious use of antibiotics only when the health of an animal is in peril.
We're sounding this alarm because as serious as the threat is, if we take quick, aggressive action, we can stop it.
Next, the Market-to-Market Report.
A record crop, demand uncertainties, and concerns over next week's quarterly stocks report moved the grain market slightly higher. For the week, December wheat gained 37 cents, while the nearby corn contract moved 3 cents higher. Despite positive weekly export numbers, anticipation of the quarterly stocks report moved the nearby soybean contract sideways with a gain of only a nickel. Nearby meal prices posted a gain of $6.70 per ton. In the softs, December cotton continued last week's rally and added $2.11 per hundredweight. In the dairy market, October Class 3 milk lost 15 cents, while the November contract moved 4 cents higher. Over in livestock, December cattle rallied $2.32. Nearby feeders rose $4.17, and the December lean hog contract posted a weekly gain of $2.05. In the financials, the euro lost 3 basis points against the dollar. Crude oil fell $5.34 per barrel. COMEX gold gained $6.70 per ounce, and the Goldman Sachs Commodity Index dropped almost 5 points to settle at 635.25. Here now to lend us his insight on these and other trends is one of our regular market analysts, Jamey Kohake. Jamie, welcome back.
Thank you, Michael.
We did see a down week on Wall Street. Was this related more toward Washington, or was this a sell-off from a little bit of excitement over the Fed last week?
I think a little bit of both. Like you're saying, we are back to pre-Fed levels in the equity markets. There is a lot of uneasiness out there with the debt limit coming up next month, the CR, continuing resolution fight ongoing right now. And then, of course, I think the big one, the tapering. The Feds did not taper at all last week. It looks like they may be now ready to in December, but all that big rally with the Feds, now we're taking it all back off. Seasonally, this is a bearish time of the year. I like selling rallies. I like selling the December S&P at 1725, get a little bit of a bounce to sell into. We've also had a lot of fund liquidation. It's end of the month. It's end of the quarter. So just a very slow trade the last week and a lot of profit taking.
All right. Well, let's take a look at the grains. We are up this week on wheat, 30-some cents. Is that going to continue, or are we just following corn higher?
I think wheat can separate itself here short term. Great week, like you're saying, saw an uptick in exports, and that is going to be the key here longer term is the export number. We've got a short crop down in Argentina with their early freeze. Russia and China have a short crop as well. China's wheat is at an all-time high, so the expectations are a lot of wheat to be moving into China to support our market. I think we push up to towards 694. We had a great close today above the 100-day moving average. That was at 678 area. So I think we're looking right at $7. The funds are short, so this thing could get very, very explosive if we can keep the export number, very, very high.
And now one of the stories all summer in the wheat market has been the great global supply. Has this Argentine freeze affected that in a big way?
It could longer term, and also the Russia-China situation as well, where we're actually back competitive again on the world markets. Just here a couple weeks ago, the talk was, we need to sell off more, we're too high priced. Now we're fine because China is at an all-time high pretty much. We've got a very weak dollar as well, based off the same situation with equities, tapering, debt limit talk.
So that 694, you think we'll hit it soon?
I do. I think we could be pushing, upwards of 7. We got a report out Monday morning, stocks report, see how that plays out. If it's supportive, I'm looking right at $7.
Now, taking a look over at the corn market, we do have some harvest reports beginning to come in. By and large, the reports seem to be a lot more favorable than farmers were anticipating. Is that starting to filter into the market?
It hasn't very much. Like you're saying, that the small sample that is coming in is pretty decent, better than I think what was expected based off the weather this summer. But the key number for December has been 444, 445. Those lows there, buster it, we're off to the races, maybe 420 or 430 area. But we can't seem to get through that off bearish news. So that signals to me maybe we need to see some profit taking, retrace a little bit higher, and then come back down again. I think the top side could be 470 if we get something supportive Monday off the carryout number or not. But I see this market more as range bound until we get about a third or 40% of the way through harvest once we know more information.
Now, how should producers be playing this market? Because the American farmer has been very long all fall. A lot of them don't have much sold. How should they be protecting themselves rolling into harvest?
Yeah, if you have on-farm storage, I would fill the bins up and lock the door shut until January, February, March. There is carry from December out to March. It's not exactly full carry, but there is enough out there to pay some bills. So I would store corn right now, look to forward price at sometime first quarter of next year.
All right. Now, as we take a look over at the soybean markets, we did see another little bit of an increase this week. How are soybeans shaping up across the country?
Very small sample done here as well. I would say the yields here are more erratic. I've heard some stuff on eastern Iowa, kind of what was expected, pretty pathetic. I've heard some stuff out west, very, very good. I think 42, 41 is probably where the number is at right now based off the early numbers. But beans have seen an 80-cent setback roughly. Corn was, on a 40-cent setback this week on some days. But the funds were long. Beans, they've liquidated based off those last showers, last rain we had about 2 weeks ago. A lot of talk that the last 20 to 30% of the beans are planted late could actually be pretty decent, and there was a lot of money pulled out on that. I'm a little negative here short term still, just based off of, we need more information. We got a report out Monday, here too, but I think this market could longer term maybe slide to 1280 or 1290 for November. That's where the 100-day and the 50-day moving averages are. You can slide back down into there and reload based off of how good or bad a harvest is. But right now it's still range bound. We need more information.
Now, you mentioned Monday's report a couple of times. What is the trade anticipating to see in corn and beans come Monday?
Trade would like to see right around 125 to maybe 135 area for beans, 675, 680 number for corn. I think the numbers should be supportive, but I think it'll probably be short-lived and be right back to harvest progress. Forecast looks great for next week, 70s, low 80s, clear window past Saturday afternoon to get started again.
All right. And now as we look longer term, you mentioned you're a little bit very short term. As we look longer term, we still do have a very tight domestic supply situation. Is this another example of bin it till January, February, March?
This is, in my opinion, completely different than corn. There's no carry at all in the beans. If I was combining beans, did not have them priced, I'd take them straight to the elevator and sell them. Look to re-on them later with some options, strategies, or futures. There's no incentive right now to store beans at all. I would unload them. If you got to re-on them, do it later.
Okay. Now, we do have some big stories. We take a look over at the meats. As we look at the fat cattle market, we're up $2 this week. The cash trade is up again this week. Where is fat cattle headed?
Getting a little bit overdone technically, but the market is still fundamentally strong. I'm still bullish longer term. It's been a very impressive, solid trade that we've seen. I would like to see December pull back down around 130.50, 130 area, maybe try to get long there. But I'm not chasing speculative longs up in here where they're at right now. But yeah, the cash market is strong, fundamentals are strong, and a longer term, I think you're still $2 higher by first quarter next year.
Choice box beef still staying high? Consumers still willing to pay the prices being asked for beef?
Yeah, demand is still there, even with the feeder cattle market nuts here the last 3 weeks. Very, very impressive meat trade.
Okay, and that's going to continue. Does the market think we're going to continue to see strong beef demand throughout the fall?
I think so. The way the numbers look right now, feeder cattle getting a little bit overdone there. It has been a very, very impressive trade. $6, we ran into 50-day, shot straight up like a rocket and haven't looked back since. $6 rally, like I was saying. Would not chase it here either. Look for a couple of dollars setback to get long. But it's a demand-driven market. Supplies are tight. Fundamentals are strong, demand is good, and I think there's still more upside longer term.
Now, how long would you be long? If we get that couple dollar setback, say, talking feeders, saying get that setback to, where would you look to buy? Mid?
63, 64 area, look for 66, 68. See what happens here too at the grain market. Corn has helped out drastically with the feeder cattle market with the 40 cent setback there. So see what happens here with harvest, with the corn and how that could support the cattle as well too.
And roll on through. Now, what are we hearing as far as retention numbers as people try to regrow their herd now with lower corn prices?
Yeah, we should see something, next spring. But this rally here right now is based off of what we had in the past, where the feeder cattle numbers tightest since the 50s. Guys down south, lost, pretty much a herd last spring with the weather, and there's just nothing out there pretty much. And the market, is rallying off of that with the cheaper corn.
Now, we've been talking about that for the whole year. Really, that's been the talk in the cattle market. Fundamentally, it should have been rallying really last December, we all anticipated. Why is it kicking into gear right now? What's driving it today, this past 2 weeks?
I think it's more corn, and then the cash market, has really started to move as well too. We kind of got caught here with this seasonal weakness in the fat cattle through the summer, from late spring, July time period, seasonally kind of bearish. Kick that out off the side, get back to lower corn trade, and we've seen money pour in there, and it hasn't looked back.
Now, as we continue to climb, if we get up into that $1.68 territory, is that still profitable for feedlots to feed a $1.68 feeders and then try to market them even at $1.30, $1.32?
If $1.32, you could for Fab time period, we're $1.33 and change here this week. But it's gonna be tough to, I think, longer term, depending on what corn does. I think that's gonna be the key, your inputs. But this thing could get wild, and I think it will. It's going to be a fun play here through the winter months.
Now, and we're talking a lot about corn. Is the market still anticipating a very large corn crop out of South America? I know we're looking at a lot of beans. Corn also increasing?
Yeah, not as big as beans, so I probably have a record amount of beans planted down there for this coming year, and it'll be weather market down there as well. But the key here of the corn market is going to be, can we get 14 billion domestically, and what happens with demand? Is Mexico going to continue to be a big buyer? Does South America overlap us here, come period in March or not, and see how that plays out.
And then there's also the question of the RFS, Renewable Fuel Standard, and what happens with ethanol. Going to be playing out over this next year. Now, we did have a big report out today, quarterly hogs and pigs report. The hog market has been on a roll most of this summer. The trade was anticipating lower hog numbers. Talk about where the report put us and what do you anticipate come Monday?
Yeah, the report came in a little bit bearish, looking for a softer opening Monday, 50 cents to $1 lower, or the early calls right now. The marketing number was the key there. And hogs, like you're saying, 52-week highs, been supportive of pretty much a reiteration of news that we already knew about, but the funds bought into it. The pet virus, Smithfield got their deal finalized this week, and then some money, ahead of the hog and pig report, thinking it might be bullish. Hogs are overdone up in here. I think they could set back $2 to $4 just on fund liquidation.
Back to the mid-low 80 level.
Yeah, 85.5 for the Christmas contract is where I would look to. And I think this could be maybe the first stepping stone that the highs are in here short term, and the fund liquidation could start real slowly. I would like to see the kill number pick up, run around 435,000 a day right now. I'd like to see us get up around 450.
And that would put us more in tune with historical slaughters, or at least last year.
Yeah, around 1.2 plus that area, 1.2 million for a week. But get that back up into some decent areas, see some fund money pour out over a couple weeks span. I think you can set back pretty quick.
Now, as we look longer term, we're seeing the hog herd increase rather quickly. How low could the hog market go if the numbers come back quick?
I think you could still see sevens in front of the hog number, coming into spring.
All right. Thank you so much, Jamie. Appreciate you being with us today. That wraps up this edition of Market to Market. But Jamie and I will continue our discussion and answer some of your questions in our Market Plus segment on our website. You'll also find audio podcasts and streaming video of our program, as well as links to our Twitter feed and Facebook account exclusively at the Market to Market website. Be sure to join us again next week when we'll examine the impact of the quarterly grain stocks report. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.